So, US stock market officially entered a bear market on the 13th of June. And here in Australia, the stock market is having a big correction. Haven't crossed the bear territory yet. You feel a little worried because your portfolio value just evaporated a couple of thousands. Don't worry, you're not alone. Our portfolio was down 8% in the past 3 months, so we're all in the same boat. As this is the systematic market risk that is unavoidable as long as you're investing. I know everyone might be wondering, when will this bear market or correction last? I can tell you straight away, nobody knows. But in this video, let's put aside the emotion, try to find a clue how long on average it took the market to recover in the past. We'll also look at how did it happen this time, and most importantly, 5 things that you shouldn't do during a bear market. My name's Irene. Now let's get started. Firstly, let's differentiate between a market correction and the bear market. So a market correction is a value drop from 10 to 20% from the recent peak. A correction can happen to an index or an individual asset. Since World War II, there were 25 market corrections to S&P 500 index with an average decline of 14%. For example, ASX 200 index recent peak was around mid-August last year, with 7,628.9 points. If it drops below 10% of 762.8 points, meaning if it crossed 6,866 points, it will be in a correction, which it did happen on the 27th of January this year. Market corrections usually have shorter durations than bear markets. The average length of a correction of the S&P 500 is about 4.5 months. Now let's talk about bear market. So all bear markets begin as market corrections. If the market keeps going south for another 10%, it will officially enter a bear market, like the S&P 500 did on the 13th of June, when it fell 22% from its recent peak on the 3rd of January. Compared with market corrections, a bear market generally lasts longer with an average of almost a year, and it can take somewhere between 5 months to 5 years to recover to the previous highs. There were 13 bear markets since World War II, including the one that we're currently at. So since 1946, for S&P 500, there were 38 market corrections. 34% of them turned into bear markets. Statistically, bear markets happen every 6 years, and every 2 years, there was a market correction. And here we're talking about a broad market decline of at least 10%. So if you think about it, they actually happen more often than we think. We've been talking about the bubble for quite a while, so in some way, we're catching up on the delayed correction that we were supposed to experience in 2020. Yes, we did have a market crash, but it recovered pretty soon and pretty well. Besides the market overheating, how did it happen this time? In my opinion, there are 3 primary causes of concern among investors. The number one concern is the interest rate. So when pandemic happened, central banks from all over the world dropped the interest rate to bail out their economies, which encouraged borrowing and investing and subsequently caused inflation. The near zero interest rates are now coming to an end as the governments are using quantitative tightening monetary policy to combat the high inflation. However, it generally will come with the cost of slowing down the economy. The high interest rate or cash rate or Federal Reserve funds rate, we might call it, is one of the basic costs when banks set their interest rates for savings and borrowings to individual customers, because this is the interest rate banks and other lenders have to pay on the money that they borrow from each other. As of shooting today, US federal funds rate has been increased to 1.75% from the pandemic level of 0.8%, and RBA has just raised the interest rate to 1.35%. When the cash rate is rising, the banks and lenders would offer higher interest rates, generally both savings rates and the lending interest rates. Both of them will have the effect of lowering the market demand as well as reducing the money supply in the economy, therefore pulling the inflation back to normal. Because number one is the higher savings rates will encourage individuals to save more and spend less. As consumers don't spend on products much, companies' revenue will drop, then indirectly slowing down the economic growth. Number 2, higher lending rates means higher borrowing costs for both companies and individuals. For companies, the rising borrowing costs will lower their earnings, which essentially will affect the stock price. On the other hand, from a stock valuation point of view, To work out the present intrinsic value, we use the estimated future cash flow discounted by the expected rate of return investors expect. Higher cash rates increase the discounted rate of return. Each dollar of future earnings will be discounted more, leading to lower present intrinsic value of the stock. So this QT monetary policy might trigger a recession if the rates go up too much or too quickly. The second concern from investors is the inflation. While we're waiting for the rising interest rates to kick in the economy to fight the inflation, we're still in a high inflationary environment to a point that we can visually see from our weekly bills. The increasing living costs make it hard for individuals to have much leftover cash to invest, and also to run a business in such an environment with broken supply chains, shortage of workers, makes the companies no choice to pass the cost to consumers, which will also affect the company's earnings. On top of that, rising commodities prices have also been pushed upwards by Russia's invasion of Ukraine. As we know, the stock market is always looking for the future. This high inflationary environment sets a pessimistic prospects from the investors, therefore causing the sell-off. The third concern from investors is the bond yield curve inverted in April temporarily. In early April, the 2-year and the 10-year US bond yield curve temporarily inverted, which caused a lot of panic on Wall Street. Why? Because usually an inverted bond yield is a leading indicator of possible recession. When everything is normal, you should see the bond yield curve to be in the shape of upward slope, meaning the longer-term bonds offer higher yields as the bondholders are exposed to uncertainty factors such as how the interest rates and inflation are going to pan out in the future. However, when the short-term bond yield surpasses the longer-term bond yield, the bond yield curve looks inverted, which happens on April Fool's Day this year. It is a sign that investors are pessimistic about the long term than the short term. Although there's no 100% correlation between the inverted yield curve and recession, looking back the 6 recessions since 1978, a recession tends to follow roughly 15 months on average after the curve firstly inverted. If a bear market and the recession comes together, the stock decline average was about 35%. Nobody likes bear market, but it's a good time to remind yourself to take a cool head to look at investing, as it has been a joyful bull run in the past 2 years.
And the key organ in your body in the stock market is your stomach. It's not the brain. All you have to know is you're going to see it's always going to be scary. There's going to be always something to worry about. And you just have to forget all about it, cut it all out, and own good companies or own turnarounds.
A good investor needs to have the ability to control their attempting behavior when investing. Here are the 5 mistakes that you don't want to make during a market downturn. Mistake number 1, not knowing what caused the market correction. A downturn market is a perfect time for us to take a step back to understand the economic environment, which I had pretty much talked about earlier, maybe a little bit too long. And this will help you to be more proactive to prepare for an extended correction or prolonged bear market. It doesn't mean that you should be selling the assets. On the contrary, you may need to do everything that you need to do to avoid the chances that you have to sell, which will make you from paper loss to locked-in loss. Everyone wants to buy low and sell high to build wealth. However, many of us sadly often do the opposite because we fear that the economy may first get worse and the recovery will take years. And this is absolutely possible, and the thought is completely understandable as well. This is because most of us are risk averse, which makes us feel more pain of the loss than the joy of profits. But we don't want to make a fight or flight response without rational thinking. Remember, the stock market is often looking to the future of the economy. So by the time any economy happens, stock market might be on track again. So try to stay calm and stay the course. Mistake number 2, not keeping extra cash. There are 2 reasons to keep extra cash during a market downturn. The extra cash can give you buffer to pay everyday bills so that you won't be forced to sell your investments at an unfavorable time. Number 2, the extra cash can give you the ability to do dollar cost averaging with the boost fund to top up your investments during a market downturn. I know we talk about it's not wise to time the market, as you never know when the market hits the bottom, but your long-term return is determined by your average purchase cost. The lower, the higher your return will be in years to come. If you have a fairly long investing horizon but still hesitating to buy more of the broad market index fund or ETF, Let me ask you something. Imagine the market correction didn't happen and you were happily dollar cost averaging monthly. Life goes on, then the market plummeted. The price you got last year is certainly higher than the price that you will get now. You were even happy to pay for the higher price, which would take longer for you to reach a certain return as your purchase cost is high, then what stop you from investing or investing more? Did you lose the faith of economy? If so, you may as well cash out all your investments and quit investing. Mistake number 3, not sticking to your goal. Another mistake that we tend to make is changing the investing styles in reaction to market performance. The tech companies are not doing well. Let me switch to commodities and consumer defensive stocks, which are more robust during a market downturn. I'm not saying periodically rebalancing is bad, but changing your portfolio exposure in response to market performance is no difference in market timing or selling your portfolio. And what you should do is to probably have consumer defensive assets positioned in your portfolio as a hedge to prepare for any possible market correction in the future. Remember, statistically, every 2 years, it will come. Mistake number 4, ignore great opportunities. When market correction happens, all of a sudden, all the stocks seem to be on sale. Yes, you should take the great opportunities to buy a good company with solid balance sheets and brighter growing prospect. You can also fall into the trap of buying the dip blindly into lousy companies whose stock price looks cheap. So the opportunities here should be the companies that you've been following to make sure it's a great company and only pull the trigger when it has enough margin of safety, and also consider dollar cost averaging to smooth out your purchasing costs when you are doing it. Mistake number 5, not diversifying your investments. A properly diversified portfolio can prevent you from catastrophic losses compared if you had invested into a single asset or sector. In this video, I use an example with numbers from history to demonstrate how a diversified portfolio can help you hedge a market downturn. My name is Irene. Keep safe, stay well. I'll see you next time. Bye.